All right, guys, welcome back to another video. And if you're new here, thanks for stopping by. Hit the subscribe button now as each of the videos builds upon the previous day's analysis. We have some major things to look at today. Some pretty big moves have begun. If you miss these sections of the moves, you basically miss the bull run. Not just my opinion and not for some clickbait title. It happens, and we're going to look at the data in today's video for Bitcoin and for cryptocurrencies. I also want to give you something practical to use from this point forward, especially for Bitcoin and cryptocurrencies. But of course, I'm going to cover everything in today's video as it's your home of macro cycle analysis. Bitcoin, cryptos, the stock market's a big one today, and of course, the real estate cycle. I think things are just kicking off. There are going to be surprises in the market along the way. That has to be expected. It's not going to be a straight up line, but we're going to cover it here as best as possible with the best analysis for you guys on the channel. I've ranted long enough in the intro. Let's just get straight over to the charts and then the data. BTC hit $66,500, $50 short, at least on the Coinbase chart, of the swing top on the 27th of September. It came down, it gave us two opportunities. One big move down to 59, and then the next big move down to 58.8. Basically, it was my China low. It was 58.888 on the Kraken chart, a beautiful number there. That was dead on the 50% level of our higher low, and then this top, which broke past the 65K level and gave us the overbalance in time and price. That's what the OBT and P is. This is a magnificent rule that we use to identify change in trends. It doesn't happen 100% of the time, but it happens often enough that we're able to put the probabilities in our favor and let us know that it's very likely that things are changing for the better, or if you see it in reverse, for the worse. And we are in the better stage. We will see it, and that will come around the peaks or some significant pullbacks along the way. So where we've come from here and what I think is happening next, obviously we had our TIA bearish signal that 3 days, in this case 3 days down from an extreme peak, an extreme turning point. That's what that was right there. Now when that signal happened in March, I tried to give everyone as much warning as possible, but the sentiment at the times are very, very different. They are extreme opposites to what you're seeing in the charts. I suspect that's going to happen again as the market takes off and we start to get to new fresh highs, and there are new all-time highs that are occurring, because if I can find my little link here, you can see things like this popping up. This is going to be in our faces. So we need to stay and remain level-headed and just take the information for what it is and just keep following the charts, because the charts are going to give us the answers, or at least give us some insights to the likelihood of what happens next. What I've got here is BlackRock's Larry Fink on what's really driving Bitcoin, yada, yada. Larry Fink says that he thinks Bitcoin will become as huge as the US housing market. That says $50 trillion, which is Bitcoin's 1.3 trillion currently, which would be a roughly 38x. A 38x on Bitcoin's $66,000 price point at the moment would take it to about $2.5 million. Now, this is even more bullish than what Cathie Wood talks about. It's not as bullish as Michael Saylor, but Michael Saylor is on another planet. And in terms of what will potentially happen with Bitcoin, no one knows. Not even the heads of BlackRock. We don't know if it's going to get there. Some will argue that it can get there. I don't care. It might. But what the headlines typically miss is a date. So giving us a time frame of this. Maybe Larry Fink thinks it will happen in this cycle. I think that's utterly ridiculous to think it's going to go a 38x in this cycle. I am extremely happy to be wrong on that. But the main point I bring this up for is that we're starting to see different faces now that are telling us the price of Bitcoin, where Bitcoin could go for this cycle. I really want to stress what happens at these peaks. And if you're aware of these signals that happen at these peaks, you are going to make it in this cycle. Now, if you're unaware of the signals, if you're unaware of indicators, if you're unaware of the probabilities of how these markets play out, that is going to be your first area that you need to do right now. And that's what I'm sharing with you in today's video. Now, I'm super bullish on the markets at this point, if you couldn't tell. I think many of you have been able to tell, and you've seen it in the comments section right here. I am very bullish and I'm excited. There are going to be challenges, as I said, so we're not going to get too far ahead of ourselves, but it's okay to enjoy the movements as they come up. Now, I'm going to give as much as I can in real time here on the channel. But unfortunately, there are many people that sort of miss the message for what it is. Now, this sort of thing is strange. Hopefully you don't miss the messages, because this is going to be a fantastic bull market. And for whatever reason, some people miss it, but thank you to you guys who keep me sane that you actually see the signals yourself. And I'm trying to call it as best as I can to almost the time frame that it has occurred. So back to the time frame now. We're at 215 days underneath the old all-time high. Obviously in March, I don't know exactly how long it's going to be, but I told you it's going to be roughly 4 to 6 months. Or at least that's what the probabilities were saying as we got through April and then May. And it seemed like things were not going to get to new fresh all-time highs sooner rather than later. But here we are coming into the 8th month now of prices underneath $74,000. I think things are going to turn around over this quarter 4. Ideally, I think we see a new all-time high in quarter 4, but of course it doesn't matter. It's going to happen eventually. At least that's the way I'm seeing the markets. So that leads us to the next piece here, and this is Bitcoin. If you miss these moves, you're basically missing the entire bull market. Just taking a look at the weekly movements. Basically, you had October, 2 weeks of price movement that encapsulated most of the price movements in that period. So you had this whole consolidation starting from August when it broke down, and then the move up to the end of October, right? So it was about 10 weeks there. And within that 10 weeks, 2 of the weeks made up over 80% of the entire move. So from the low here at 27,000 to the peak there at 35,000, we're only looking at it down to $25,000. So basically $8,000 of that move, of that $10,000 move. So basically 80% of the move was made up of 2 weeks over a 10-week period. So 80% of the move was done in 20% of the time, 2 weeks out of those 10 weeks there. Now, of course, you could argue, well, take it from the 11th of September because that's that price low. The price low here on the August was very similar. Nonetheless, it is a smaller period of time that the market moves than the period of time that it consolidates for. So then I'm going to extend this out and have a look at more of these price movements. So going from this weekly top in October, this was basically consolidation again. People get bored, they leave the market. It's over, it's going to come down. A lot of people were shorting the market through here in October and November, and then pump. Now, once those 2 weeks of pump are done, the next week basically reversed all of those price gains, and then it hung out in this region for 1, 2, 3, 4, 5, 6, 7, 8. Then on the 9th week, it started to move. So again, roughly 10 weeks, 2 of the weeks did all of that price action, from 36.5 to about $46,000. Sure, it went to 49, but came back into that price zone. And then you finally started to move again. Now you look forward from that point, 38,500 up to 74,000. You had 1 week here, 2 weeks, 3 and 4. A lot of the moves were done within this one bar alone, and you could argue possibly a few days either side of this particular week here in February. So to call it maybe 3 weeks within this particular period here of 1, 2, 3, 4, 5, 6, 7, 8 weeks. So again, under 50% of the time, that was the price range, the price moving in that period, right? So if you're missing these timeframes, you're missing the shortest period of time after these consolidating moves, then you are going to miss all of that price action. Basically, everything that the market has been winding up for at this point, you pretty much miss it as it starts to break out and take out those new levels. Now, as I said in the intro, I'll give you something practical to use here. If you are not in the market and you're worried that you've missed out on the opportunities, you're worried that there's going to be a pullback and what's the point of getting in now? There can be a pullback. It could push higher and it can come back underneath these levels. But the real scary part, the fearful part, I guess, if you don't have a plan, that's the fearful part. If you've got a plan, maybe look to enter when the market breaks out of the tops. At least this is how I like to trade the markets. You're basically getting on with the trend. Having said that, knowing that, it can come back underneath, which is why you need to understand where those levels are underneath the market to invalidate that move to the upside. So there could be some levels here like these lows where you say, look, if it does push up and then starts to come back down, I take the loss. I take the loss, get out of the market and wait to see what happens next. Do we start to see a further downside trend where I've done well and I say, well, I got out here, I took this loss, I took the range here of this loss, but the market went further, so at least I didn't lose more. That's the problem there. Now, I know this is sounding quite bearish for a pretty bullish move that I think is coming up, but it's always important to be extremely prepared when the emotions get even more rampant, when we start to see higher prices, because these moves are going to get more and more volatile. You can just look back to the previous move that we had, the volatility going from 40 to 49, back down to 38 over the course of a few weeks, shakes up the emotions. And if you don't have that written down somewhere, whether it's on a computer or paper, then you're basically going to miss those moves, or you're going to play the moves really, really bad. And you don't want to do that because the amount of time that the market moves for is very short in comparison to the amount of time that it spends winding up. Now, this week's free TIA report goes into this in more detail, along with other altcoin trades that we're looking at and the real estate cycles. So if you want to get access to this free report, the link in the top of the video description, hit that, subscribe to the list, and you'll get that within the next 12 hours. So let's carry on with the next piece of analysis, the 18.6-year cycle, the winner's curse phase, lots of liquidity continuing to come back into the market, whether that's the Fed printing money, whether it's China's Fed printing money, or it's the banks creating more credit or creating credit more easily for people to get access to. That's all part of this final stage to the peak. Now, a lot of people have asked about what do you do after the peak? Where should you put your money and all that sort of stuff? This is individual because people have different beliefs about what they think is going to happen to the world after a major economic peak, after a major market peak. So it's really individual. I don't think we're going to go back to any sort of major gold standard, but there are different people out there. That's absolutely okay. Do what you need to do. That's what the market's made up of. Everyone's got different opinions. At these peaks, towards these levels, what we typically hear, like we heard back here in 2020, around that peak there, and in 2021, is cash is trash. Now, whether the people who say that are saying it at the time, or the media is just recycling stuff that they have said at the lows in the market, because cash is trash at the lows in markets. You want to be in assets and not holding cash. So unless they are recycling what these guys are saying and then telling you that at the peak, that is what we'll probably hear towards the peak. Cash is trash. You want to have your cash in the markets because, well, cash is becoming worth less because assets are going up. And you'll hear that even more so at these peaks. That is a time where it's probably likely cash is not trash and you want to be holding more cash, because eventually you start to see this roll over and cash becomes worth more because asset prices are going down. Now, it's not going to be a ring the bell at the peak, sell everything, hold your cash, and then the next day it all starts to collapse. You might get that lucky, but it's probably unlikely. And that peak could take 6 months. Maybe you're out of the market for 3 months, 6 months. I don't know. But we're going to keep watching this as we continue on with this 18-year cycle, this 14 years up into the peak, before we get this final peak of the cycle and everything comes rushing down after that point. But for now, I don't think it's any time to be worried about bear markets or major collapses. As I've said this for many, many years, everyone that's been talking about recessions through 2021 or 2020, 2021, 2022, 2023, we're now into 2024 and there's still no recession. What we are seeing are very good signs of further upside. This particular one here is just looking at seasonality of different ETFs in the stock markets. Now, I talk about this on top of Bitcoin and cryptos because you want to see the rest of the financial markets also doing well. Essentially, these are the less risky things, and when less risky things are going up, that makes people feel more confident and they start to look for other areas of the market to speculate in, or call it gambling, whatever you want, right? And so they'll start to take their money out of these things, or a little bit of it, and start to throw it into more riskier things like Bitcoin and cryptos. So here we are looking at the ETFs in the US markets. These ETFs are showing seasonality towards the end of the year of rising prices. So from where we are now in this sort of volatile period, uncertain period before the US election, we're seeing prices continue to rise with volatility increasing as the markets have been rising. But across the board with these ETFs, you're seeing the end of the year, quarter four, seasonally speaking, has pretty good returns. Now, this is looking at the Russell 2000. This one before was looking at iShares MSCI. The ones that I'm interested in are the financials, the Dow Jones, also showing a run to the year end. So from day 196 to the year end, which is basically around 252 trading days of the year. And then you're also looking at the consumer staples going up towards the end of the year. The materials sector seasonally going up towards the end of the year. It looks like we've been through these times now, right? These sort of uncertain periods, these corrections, and then the hold up, and then the pause, and then another correction. Basically, end of the year across the board is looking pretty good. Technology also going up, and essentially just looking at a summary here. So just in summary, although seasonality shows that a lot of these things are going up, a lot of the ETFs are going up, the stock market's going up, everything's going up, real estate's going up, new all-time highs for Australia. $11 trillion real estate market, right? Everything is on the move here. Doesn't mean it's the only thing to be looking at, but if you're seeing the price go up, which is basically your trend, and seasonally speaking, it's also going up, well, that's a pretty good idea of what is likely to happen next. So basically the probabilities are on your side to be in the market rather than out of the market. And that's just summarizing the summary here for you guys. On top of that, now I'm not a macro bull or a perma bull forever. I do spin to bearish as well. Like you saw this year with March, it looked like it was going to be a pretty decent correction for Bitcoin. But on top of that, end of the year, quarter four, big moves, leads into 2025. 2025 might be very, very big. Massive, massive year ahead. The Dow Jones 10-year cycle, I've looked at this before, but this is a 10-year cycle. So it's not going to change. You're going to look at it and then just look at how the seasonal patterns work for the years ending in 5. Might be the first time you've ever heard this, but pay attention to this. Years ending in 5, provided they're not Shemitah years. We'll go into different cycles in different videos. But yeah, if you are Jewish or understand the Jewish calendars, that's your 7-year cycle. To the side here, the 5th year, massive bull market. That's what we want to hear. Massive, massive bull market years. Then we get to years 6 and 7. Things can get a little bit trickier to trade. But for now, generally, years ending in 5 are years that go up. That's what I want to leave it at for this particular video. And we can continue to focus on that as the 2025 year rolls around. S&P 500 is at a new all-time high. Can you believe it? The thing I'm still concerned with is this one here. 4 to 5 week volume fill. I've talked about that multiple times on the channel. You can see the price starting to increase from here, but then from the 23rd of September, the volume has started to wane from the market. The volume has started to decrease here. And what I've noticed over the course of history here for the S&P 500 is when that volume does start to drop off, you generally see a bit of a correction come in. So that could happen around the election, maybe before the election, as you see volatility spike and people get a little bit freaked out with what's happening. You might see some big bars down for the volume to fill here and the price to come back and fill in this zone that had low volume. That's a possibility, but for now, the trend is up, the prices are up, new all-time high for the S&P 500. There's nothing else to do here apart from sit back and ride the trend. The trend is your friend. On top of that, cyclical stocks dominating the new highs list. So this kind of goes hand in hand with these cycles here, these seasonal moves. There's cyclical stocks dominating this. Basically, you're seeing a lot of stocks go to new record highs and new 52-week highs. 52-week high list. That is an important one to note because when a lot of these stocks, in this case, over 15% of the sector, and in this case, all 3 sectors, you've got your financial sector down here, and then another 2 sectors I forget the abbreviation of. Essentially, the prices continue to go up, just looking at the probabilities. So it looks like we got further upside to go. And this was another big one that I spoke about months and months ago when it came to BTC and the monthly chart for the breakout of the S&P 500. So S&P 500 breaks out to a new all-time high. Bitcoin follows suit, basically moving up. It doesn't necessarily have to be an all-time high, but then the S&P corrects. Bitcoin also corrects. And then the S&P goes on a move and is the precursor, the leading indicator. Who has leading indicators out there? We do. A leading indicator to the Bitcoin market, and then Bitcoin follows suit. Having said that, Bitcoin hasn't broken to new all-time high, so I might have to calm my nerves just a little bit here before things, before it happens or doesn't happen. Looking at the probabilities, I suspect Bitcoin is also going to go higher over the course of the next several weeks. Now, just to finish off the data on this pattern here, the cyclical stocks dominating new highs list, you're seeing new highs in all of these sectors here. And when you look at the data going back to the 1950s, 86% of the time, 12 months later, the stock market is higher. I suspect that is going to have a flow-on effect, obviously to stocks, but to Bitcoin and then to altcoins as well. And sure, I've been saying this for some time, Bitcoin has essentially been winding up for this period. Well, what I think is happening, I think it's winding up, giving us a couple of these higher lows. Invalidation, I've talked about that. I don't want to bring this video down into some sort of bearish thing, but we'll continue on with the bullishness and worry about the invalidations. You can watch the beginning of the video for that as well. Interesting to note here is that the banks and other funds around the globe in December of 2023, these were their price targets for the S&P 500. Guess what the S&P 500 is now? Almost 5,900. The E-minis is at 5,900. So it just goes to show that the banks and most of these guys have zero clue about the market. You could give it to these guys who have talked up the market around 5,000 because at the beginning of the year, the S&P 500 was 4,800. So these guys were ridiculously wrong. These guys were not bullish enough. And well, look, essentially here, this is what the S&P 500 is at now as of a couple of days ago. So we're just following the trend. Markets are up. Basically, every single bank got it extremely wrong and we're not bullish enough. And in some cases, most cases actually, all these guys were way too bearish for this market. Now I've got heaps more data to get through, but the video's gone on way too long. So let's just click over straight to cryptos and I'll get back to some more of that stock market data in future videos. So make sure you hit the subscribe button, like the content, and if you want that report, link in the top of the video description, subscribe to that right now. So the total cryptocurrency market cap, this is everything including the stables, BTC and ETH, is breaking above the downtrend here. So we have the diagonal downtrend. That's a really good start if it can hold that level for the close this week. We have higher lows. That's number 2. Look at these higher lows forming. Number 3, breaking above the 50% level at 2.2 trillion. Remember, above 2.2 trillion, we're looking strong. The fact that we've got higher lows as well, another good sign, and that it's breaking the diagonal downtrend, meaning we're looking to break to the upside, is a really good sign there as well. On top of that, the correction that we saw into that low of August hit dead on 50%. So again, this is the importance of 50% levels, learning those and understanding how to use them in your trading. Low to the high of this entire bull market bounced on 50% and seems to be breaking above the downtrend 50%. So another solid sign of strength here. So all of that in terms of the charts, the trend is looking pretty good. Once we get a break above 2.3 trillion, so around this top, that's going to continue to confirm the higher highs and higher lows on the weekly chart. Now, I talked about if you miss this move, this sort of move next, then you could potentially miss out on the entire bull run. And I bring that up when it comes to this, because if these guys actually stuck to their targets, they missed out on the entire bull run of 2024. And we got new all-time highs 10 months later into 2024, again and again and again. The banks, where people trust their money, they missed out on 2023, markets going up. They missed out on 2024 if they actually stuck to these things, markets going up. I don't want you to miss out on the markets going up as well. Just follow these charts here. Don't follow any of these other guys. Anyway, in terms of the time frames themselves, we can measure from the low to the top. That gives us around 26 weeks. So basically dead on 6 months. Within that 6-month period, 8 of the weeks, including this little week here, which was an 8% gain, 8 of those 26 weeks basically did all of the gains. 8 out of 26 is 30%. So 30% of the time, the market did the gains. The other 70% of the time was either pulling back into the same gains, was either consolidating within those same gains, was either pushing out a little higher to come back into those moves, so essentially consolidating again. So 70% of the time the market wasn't doing anything. Now that's the total cryptocurrency market cap, and we looked at that earlier with Bitcoin as well. So roughly around the similar timeframes here. What do we do from this point forward? Well, we looked at the analysis for trading them. We've looked at the strength that is forming here, and I talked about an action plan that you could start to build for yourself, looking at trading with the trend. If these trends have further to go, as we've just covered here, the low to the high was about 26 weeks. Previous moves have gone for longer than that. Some have gone for shorter than that. But if we start to measure each of those moves, well, then probabilities would suggest that we have only just begun this particular move. Remember, always have the invalidation levels. We're going to see pullbacks. We're going to see more volatility. That's just part of the game. That's what shakes people in and out. But if we've got this particular data, this analysis to back us up, it's going to make life way easier when that time comes, when we get the breakout, and then those severe pullbacks. The volatility is going to be extreme, okay? So just bear with it and make the profits as the market goes on. We are 10 weeks into this move. As I showed you here, that was about 26 weeks. Where does 26 weeks take us? About February. 20 weeks takes us to about December. So keep in mind, late in Q4, maybe early in Q1 of 2025, we could begin to see some sort of volatility happen at those times where you might see a quick pullback. We saw it in 2024, we saw it in January and then into February. So that was only a matter of 1-2 weeks of pretty decent moves there, a smaller week here, and then the week in January, which pulled back to take out those lows. So you had 2 volatile weeks, shook a lot of people out, this week here as well, and then it continued to carry on from that point. So included in your action plan now, if you haven't got into the market, you now have a time target. Most people try to do price targets all the time. I don't like price targets because the market could keep going, and you're better off, in my opinion, at least following the trend. And then if you've got time targets based on what the markets have done previously, that puts you in a stronger position, in my opinion, of course, to be able to identify maybe where these pressure points come in, and maybe the market's just going to take a bit of a cooling off here, just like we talked about in March of this year. So it happens time and time again. Now, a couple of the last things I want to look at here are the previous moves, just to cement home the point that if you miss out on these moves, it could be quite some time before you're able to get back in. And that's really not a great feeling in the markets. The move out of the low, the cycle low, until we started to break out again was about 47-ish weeks, about a year, right? Here you go, November into the end of October. So about 11 months. 2 weeks made up the majority of the price movements. There's 800 billion up to 1.2 trillion. And the entire move itself was about 730 billion to about 1.25 trillion, right? So these 2 weeks alone made up the majority of the moves. The rest of the time was sitting around and waiting for the market to move. So in terms of a percentage, I don't even want to know, but it's like a few percent of the time the market was moving in that case. I don't think this is going to repeat. I think it's going to be more like this, or probably even less. You're going to see more upside with sort of less pauses as we continue on. Nonetheless, we'll continue to cover that as the market progresses. Now, a couple of the last things here were the ETF flows. I see people getting excited by this. I don't think it's a great metric to use to determine whether you should be buying or selling. You can see some of the times where it was the worst time to be selling was the time that had the most amount of selling going on. It's like looking at the volume on a chart. You're better off just looking at the chart itself, right? So we'll continue to look at this as well, but essentially ETF flows, really bad metric to use when it comes to trading plans and using it as a confirmation that you should be doing what the ETFs are doing. If they're buying, you should be buying. If they're selling, you should be selling. The Bitcoin dominance. This one's a pretty interesting one. Just looking at it on a yearly basis here, 1, 2, 3 particular years of movement up. When we look at it broadly speaking, one massive year down. 1, 2, 3 years up, broadly speaking. Do we see this massive move down, or maybe a more subdued move here, which means that Bitcoin still would be doing well, but some of this money could flow out into memes and other smaller altcoins, smaller market cap altcoins, which wouldn't affect the Bitcoin dominance as much. For the Bitcoin dominance to get smashed like this, now you would need the larger caps to take a lot more dominance back from BTC. Does that happen? I don't know. I'd be putting my money into some smaller stuff and larger stuff just to sort of keep it a bit broad from that particular point. The last one here is Sol. So speaking of that, we'll have a quick look at Sol. It's broken past the 50% again. The good news here is that we're seeing higher lows upon higher lows upon higher lows. We're still waiting on this massive breakout of $164. That would be a pretty key level for Solana to get above, consolidate, which would then put it in a good position to start to take out that 180, 190, maybe even 200 level in the foreseeable future. More on altcoins in future videos. Hit the like, subscribe to the channel, and check out the report that's coming out to you in the next 6-7 hours. Thanks again for joining me here. I'll see you back at the next video. Until then, take care and peace out.